bell rang 15 minutes ago. Let's get right to it. If you were looking for a clean, conviction-backed directional day, well, today wasn't it. But we did resolve higher.
We did.
So let's hit the scoreboard. Final prints. S&P 500 closed up 0.45%. The Nasdaq, it led the charge again, gaining 2.81%. And the Dow barely moved. Finished up just 0.22%.
You know, the headline number doesn't tell the story at all today. This was a textbook choppy mess. That's the only way to describe it. It only resolved higher because of a very specific, very late day move.
So not a strong trend day by any means.
Not at all. We spent most of the session just battling mixed signals. But that rally into the close, you need to understand this, was driven by highly targeted institutional money. They weren't buying the whole market. They were buying very specific addresses.
And you can see that so clearly on the leaderboard, right? That targeted allocation is why the prints look okay, but the tape just felt soft all day.
Exactly.
Technology was the clear outperformer. It's that perpetual AI tailwind again. That was the engine that pulled everything out of the mud in the last hour.
And look at the counterweight to that. Utilities got crushed. They were the biggest laggard by a mile. That sector is just so sensitive to bond yields right now.
With everyone trying to price in the next Fed meeting.
Right. And institutional capital just is not comfortable holding that kind of high-debt name at these valuations. It proves the point. This wasn't a risk-on blast. It was a flight to specific quality growth.
Okay, let's dig into the internals then, because the scoreboard is hiding a lot. I want to start with a volume tape. It tells you immediately why that rally felt so weak.
Go for it.
Today's trading volume was, get this, a full 15% below the 30-day average.
And that right there, that is the defining characteristic of a low conviction day. I mean, if the S&P is going to finish up nearly 0.5%, you need to see the big money stepping in to validate the move.
And we just didn't get that participation.
Not even close. When you get price moving up on low volume like this, it just screams hesitation. It suggests the gains are from, passive flows or maybe a little short squeeze, not genuine, aggressive institutional buying. It just lacks that validation you need for a sustainable breakout.
Okay, so conviction was low across the board.
Yeah.
But you still have to follow the money, right?
Mm-hmm.
Where did the institutional footprint actually show up? We have to look at the closing print.
Yes. And the final hour was a beautiful study in divergence. It confirms everything. In the final 30 minutes, there was clear, undeniable evidence of buying the close in technology.
You'd see it on the tape.
A huge surge in buying volume.
Yeah.
The kind that looks like a fund manager just has to get positioned before the bell.
Yeah.
It pushed a bunch of key tech names right to their daily highs. That suggests real conviction, but only in that one pocket of the market.
So they were happy to press their bets on tech right into the final whistle. But that obviously didn't happen everywhere else.
No, not at all. You contrast that with what happened in energy. Even with oil prices up, you saw this gradual, steady increase in selling pressure into the close.
A classic fade the rally.
A classic fade. Managers were taking profits off the table in a cyclical sector and at the same time rotating that cash into tech. It's selective confidence, not broad enthusiasm. And you have to understand that distinction.
That brings up the big question then. If only a few mega caps are doing all the work, how healthy is the market structure? Let's talk market breadth. Let's look at the advanced decline ratio.
And the AD line confirms our suspicion. Today, the ratio was near 1.0, basically an equal number of stocks advancing and declining.
Which is terrible for a day the S&P is up 45 basis points.
It's awful. You want to see that ratio way, way higher than 1.0. You need to see the underlying stocks participating in the rally.
So the old analogy holds. The generals moved, but the troops just sat there. Why, though, should we care if the index itself is up? A win is a win, right?
Well, here's why it matters to your capital. Think of the market as a giant ship. The engines, which are the big tech stocks, are running full speed ahead, pushing the S&P forward.
Okay.
But all the lifeboats, the smaller stocks, they're just sitting dead in the water. When the index is pushed up by just a handful of names, it means the leadership is narrow. And narrow leadership makes a rally incredibly fragile. It's prone to sharp reversals because there's just no underlying foundation of
support, right. The whole structure is brittle.
Exactly.
And if you connect that weakness to the fear gauge, the VIX, it gets even more obvious. The S&P gained today, but the VIX was stubbornly flat. just hovered around 18 all day.
That's the other fascinating piece. The market rose, but implied volatility wasn't crushed, which is what you normally see. On a strong up day, traders rush to sell their expensive hedges, and the VIX collapses.
But not today.
A stable VIX like this signals deep underlying caution. It means traders are still paying up for protection. They are actively pricing in future risk. They are not buying into this rally.
So let's connect the dots here. We had a rising SPX headline,
On low volume.
a flat AD ratio,
And a flat VIX.
it's a clear and present bearish breadth divergence.
It's the definitive tale of two markets. The headline index looks calm, but the underlying foundation is cracking. The strength is deceptive. And you need to treat a market like this with immense skepticism.
Okay, so with that fragile structure, let's pivot to actionable setups. We have to rely on price action right now. Let's look at some key technical reversals from today, starting on the bearish side. XYZ Corp formed a classic shooting star pattern.
A perfect example of rejected enthusiasm. The stock opened way higher, but the sellers just hammered it all day long, and it closed near its lows. That tells you buyers were completely overwhelmed at those higher prices. You have to watch for follow-through selling tomorrow on that one.
On the flip side, we saw some resilience. ABC Inc. formed a hammer pattern.
Now that's the bullish reversal we look for. That's a low-risk entry setup. The stock gapped down at the open, probably on some panic selling, but then the buyers stepped in hard and pushed it to close well above the open. It suggests a potential short-term bottom is in.
And one more, a really clear momentum shift. DEF formed a bearish engulfing pattern.
Yeah, that's a powerful one. A big red candle today that just completely swallowed the prior day's green candle. It's a definitive shift in control back to the bears. If you're long that name, you need to reassess your risk immediately.
All right, let's look ahead to tomorrow's critical levels. Given the chop today, where's the support we absolutely must hold? And I'm talking beyond just a trend line. I mean, the options market structure, the Gamma Wall.
Right. For the Nasdaq 100, the QQQ, the critical level for me sits between $435 and $436. That area is a massive wall of put open interest.
The Gamma Wall?
That's the one. If that level breaks, dealers who sold those puts are forced to sell stock to hedge, and that can accelerate a decline very, very quickly. A hold there is a springboard. A break signals a much deeper correction is coming.
So that's the line in the sand for tech. What about the broader S&P 500?
For the SPX, keep your eyes on the zone between 6765 and 6778. That's where a few key moving averages are converging. A close below that zone tomorrow would flip the short-term picture pretty bearish.
One last point on strategy. If today had been a strong trend day, what's the rule for day two continuation?
It's a good reminder. The probability of a direct follow-through on day two after a high-volume trend day is actually pretty low, only around 30 to 40%. Momentum gets exhausted. So since today was low conviction anyway, you should expect either a gap and fade or just some chop around today's levels. Don't assume continuation.
Which brings us to our focus for tomorrow. Looking for that asymmetric trade, right? Low risk, high reward, especially in some of these growth tech names.
Precisely. I've got two day two setups to watch. First is the mega cap tech reversal candidate. Think MSFT, GOGL, one of those names. If it saw heavy selling that got rejected today and it closed strong above a key moving average, that's a setup for a mean reversion trade back toward the highs.
It's a defined risk entry.
Exactly.
Yeah.
And the second play is the earnings play continuation. Let's say you had a mid-cap biotech that popped 15% today on high volume after some big news.
So when we see a massive move like that, is the trade over?
Not always. Price discovery is rarely done on day one. You look for day two consolidation or a clean break of the day one high. As more people digest the catalyst, that momentum can absolutely continue. A breach of that high signals more upside.
That sets the table nicely. But let's not forget the external wildcard that could just shatter this whole fragile setup we've been talking about.
And of course, the whole thing could get thrown out the window tomorrow morning.
Right, the wildcard. We've got fresh inflation data coming.
Look, the market structure is brittle. It's being held up by very specific tech flows and that option's Gamma Wall. A surprise on the inflation front, either too hot or too cold, could shatter those technical levels instantly.
It would force a complete reassessment of the Fed and just crush the complacency we see in that flat VIX.
Instantly.
So we're walking in tomorrow to a market that looks green on the surface, but it's got a ticking time bomb underneath. Stay disciplined, watch those levels, and just remember that conviction is the one thing missing from today's move.